Hello everyone, my name is Torin Dove and welcome to today's video. Today I'm going to be going over 7 different ETFs you can use right now to diversify your portfolio. As you're all likely aware, the United States market has been very volatile recently, and I think as we've all learned, it's no longer enough to simply be diversified amongst the United States market in specifically the S&P 500 or the NASDAQ, when there's an implied reliance on the United States maintaining its spot as the #1 economy in the world. So instead today I brought 7 different ETFs that I think you can personally benefit from if they of course fit the needs and requirements of your own personal portfolio and risk tolerance. So without further ado, let's get started. Now I know I did just mention diversifying outside of the United States market, but as the stock prices continue to go down and during uncertain times with the market really hating uncertainty, you can have a great opportunity to really add into your positions in the United States markets, as I don't think that's necessarily going to go away anytime soon. It's just whether or not it will be the #1 player moving forward. But regardless, the United States markets are likely to do well. This is where the majority of the wealth is in terms of public companies, and so it's a great time if you don't already invest in a VOO or an SPY to really look in terms of that and be a very, very diversified investor. Now, I went with VOO because it has a slightly better fee, but just a little bit of background in terms of what the Vanguard S&P 500 ETF, ticker symbol VOO, is. This ETF acts as a basket of stocks that tracks the S&P 500. The S&P 500 is one of the most prominent indexes and the most tracked index for professional fund managers who use it kind of as their benchmark. VOO acts to replicate the index's performance. VOO has one of the smallest fees compared to other ETFs that also track the S&P 500, and since its inception in 2010 has averaged an annual return of 14% per year. VOO holds 505 stocks and is highly diversified across all of the sectors. Some of the top holdings include Apple, Microsoft, Nvidia, Amazon, and Meta. And then this fund also offers a dividend yield of 1.36%. Now, it is important to note that this fund is market cap weighted, so there is still a heavy reliance on the Magnificent Seven and the top larger companies, with them making up a sizable portion of any of the things that track the S&P 500. But I do think as those continue to potentially falter and investors are uncertain, then this will be a great time to pick up more shares of VOO or start investing in a VOO or SPY. Next, I have 2 specific sector ETFs in the S&P 500 I really like. So we have State Street's Utilities ETF, which is a ticker symbol XLU. This seeks to provide investment results that before expense correspond generally to the price and yield performance of publicly traded equity securities of companies in the Utilities Select Sector Index, which is basically just picking out the utilities from the S&P 500. XLU has one of the more cost-efficient approaches to specifically tracking the utilities with only a 0.8% fee, and some of the top holdings include NextEra Energy, the Southern Company, Duke Energy, Constellation Energy, and significantly more in the utilities sector. And then similarly to VOO, this ETF is also market cap weighted. Now, utilities and the next sector I'm going to be talking about in a second are very good in times like these where there's a lot of uncertainty, because both of these, the world is still going to be very reliant and customers are still required to spend money on things such as utilities and then also consumer staples, which I have in a second. So these are things that will likely, if it does go down over time, they'll perform a lot better, and by perform a lot better, that typically means lose less than the overall market, which if you invest in ETFs like this in uncertain times, you could then potentially reposition them into other investments later on down the road after we get a little bit more clarity on what is going on. So next we have State Street's Consumer Staples ETF, and this one's quite similar to the aforementioned XLU or the Utilities ETF, because this one seeks to track the consumer staples part of the S&P 500. Now, consumer staples can include food, beverage, household products, personal care, necessary pharmaceuticals, retail, and tobacco. And some of the top holdings of XLP are Costco, Walmart, Coca-Cola, and Philip Morris. And then quite similarly to the utilities ETF, this also has a 0.08% fee. Next, we start getting into a little bit more of an international focused. In these last three recommendations, at first I went with complete world, and then I broke down two of the BRICS countries I think gained the most, with the United States being uncertain and a lot of foreign investment being uncertain in it. So, without further ado, for the Total World ETF, I ended up going with Vanguard's Total World ETF. Again, what I did for all of these was I came up with the idea either S&P 500, maybe industry in that, or Total World, and then I went through multiple different ETFs to try and find what I figured to be the best one. Again, if any of the ideas sound quite appealing to invest in, do your own research. Morningstar is a great material for ETFs specifically, but Vanguard's Total World ETF seeks to invest in large companies both in the US and internationally. In terms of diversification, this is one of the most diversified ETFs you can possibly invest in. It has 9,792 holdings, and then the advantage of having a VT compared to simply a VOO is that you have a lot of exposure in Europe, the Pacific, emerging markets, the Middle East, and so even if the US market does poorly, which will still definitely affect the performance of a Total World ETF because North America makes up like 65%, but even if the US performs poorly and other markets kind of pick up the slack, this ETF will do and fare a lot better short term than a VOO. And then potentially long term, again, we're going to have to wait and see how this landscape kind of plays out, but investors absolutely hate uncertainty, and at least right now there's a lot of uncertainty in the US markets. So we'll have to see moving forward what the game plan is and if globalism really is dead, as a lot of different news articles and news sources have been pointing out. But if there is uncertainty, or if the United States kind of pushes away and try and isolates itself, you'll benefit greatly by having exposure to these other markets. Next, I went for the Xtrackers MSCI Europe Hedged Equity ETF, and this fund seeks to invest in developed markets in Europe. And the great benefit of having an ETF like this is that simultaneously to investing in those securities in the European markets, they lock in currency contracts, and this kind of hedges against currency risk. Basically, it returns the profits of the stocks without the fear of currency movements from the euros, pounds, francs, any of the currencies over there, $2. So surprisingly, this fund, while also having the added benefit of hedging against currency rate fluctuations, has a very, very low fee of 0.45%, and this is by far one of the lowest. I think it was in the second lowest quintile of any of the other funds that specifically target Europe while hedging against currency fluctuations. And then some of the top holdings in this one include Nestle, SPA, and ASML. Next, we go on to two of the BRICS nations that I think are most poised to benefit from uncertainty in the United States markets. And so starting, we have the iShares MSCI Brazil ETF, ticker symbol EWZ. Now, EWZ seeks to track the MSCI Brazil 2550 index, which measures the Brazilian stock market with a few extra rules. So no one stock can take up 25% of the index, and all companies above a 5% weighting in the ETF must stay below 50% of the total portfolio. So the ETF also has a mix of large and mid-cap stocks in Brazil. Now, for those of you who aren't aware of the Brazil thesis for this, basically Brazil, quite obviously, is one of the most mineral and natural resource rich countries, and then out of Latin America, it is like by far the biggest economy. I think it takes up about 60% of the Latin American market, and 4 out of the 5 largest companies from Latin America reside in Brazil. And also the government has been very, very vocal during some of the uncertainty and tariff concerns about wanting to try and cement its place as not just an emerging market, but a mature market, and really taking advantage of what's going on right now with all of the trade partners. So for me personally, I really find Brazil an interesting investment case. It's been one of the emerging markets I've really kept my eye on. I'd say it's probably my second favorite emerging market, right outside of the next investment I'm going to be pitching. But I really like Brazil in terms of a play in the next 10 to 15 years and kind of seeing if they can in fact become one of the larger economies and break out away from just the emerging markets and really cement themselves. And then finally, this one probably isn't a surprise to that many people, but the Invesco India ETF PIN. Now this ETF seeks to track the performance of FTSE India Quality and Yield Select Index, which tracks the performance of high quality dividend paying companies that reside in India. Now with India surpassing China as the most populated country in 2023 and the pace at which they pass them, they show no signs of stopping, it's highly likely that India's markets will become a great place to invest for a while. Also, in those population growths, it's worth mentioning that even compared to the United States or China, India has a much lower average age. They have an average age of around 28 for all of those citizens, whereas the United States is 35, and China, which is a very old population, is going up above 45 right now. Again, India is a very exciting investment in terms of any of the BRICS nations. They have real potential. In 2021, India's national budget included industry privatization, investment incentives, and tax reforms. And since then, they've continued to try and cut taxes, specifically on the corporate level, and really prioritize growing their companies and reinvesting into their citizens to make sure that they can be a dominant force in the markets to come. So thank you everybody for checking out today's video. Again, make sure any of the investments or ETFs I talked about today, you do your own due diligence and your own research. They might not fit in your specific risk tolerance. Again, investments are not guaranteed by any means, but I feel pretty confident that I've done a decent amount of research into finding the better ETFs that specifically target the things I'm interested in investing. And so hopefully this can kind of give you a baseline idea and at minimum really get you thinking about what diversification is, especially if you aren't spending hundreds of hours doing research on specific single stocks and you don't really want to take the risk tolerance that comes with only investing in single stocks. This can be a great time to kind of learn about diversification and try and not only be isolated in the Mag 7, the S&P 500, and kind of think outside of just the United States market. Okay, thank you very much for checking out today's video. I really appreciate it.